Good morning, everyone. Thank you for joining us today on this webinar. We're very grateful for you to take some time out of your day and join us. Before we begin, I would just like to get some housekeeping things with the technical capabilities of this webinar out of the way, and I'll pass that over to Rishi, our technician, just to kind of give you some guidance so that this goes smoothly for everybody.
Thanks, Chris, and welcome everyone to today's webcast. So just a few quick housekeeping items before we begin. This webcast is being broadcast live, so we suggest you enlarge your media player to full screen when viewing the presentation. Some of you may also need to enable Adobe Flash, so please do so by clicking the prompt that you see. We definitely encourage everyone to submit questions throughout the presentation, so you could submit questions electronically through a Webcast console Q&A widget that you see on your console. If we don't have a chance to answer every question, we'll be sure to follow up directly after the webcast and address these questions. We definitely encourage you to make use of the resource widget on your console for any additional information on our products and services. And finally, a recording of today's webcast will also be posted to the Duff & Phelps website and distributed to all attendees in due course. So with the housekeeping items out of the way, I'll pass it back to Chris. Chris, please go ahead.
Thanks, Rishi. First, I'd like to just start by introducing the panel and give a sense to the audience as to the catalyst for this webinar. My name is Chris Nobes. I'm a managing director at Duff & Phelps. I'll get into who Duff & Phelps is in a moment. But I started doing valuation work in 1997, so I've been doing it for quite some time, and have gone through a couple of economic cycles, each of which has been unique. But in the 2008 financial crisis, I was a lot younger than I am today. And, when it started, I was concerned with, the practice that I was running that I had just recently bought from a former owner of a firm called Campbell Valuation Partners. And what happened during that crisis was a lot of our estate planning type clients, businesses started looking into estate freeze opportunities to really take advantage of the value dip in the market to defer tax in their family planning. So I thought when this COVID situation happened, and it has its own unique characteristics, there are some similarities to the crisis in that it is a good time to freeze and to think about some estate planning issues for business owners. So I thought it'd be a good idea to reach out to Ian Hull, who I've worked with over the years, and his practice, and see if we could put a joint effort together to educate business owners and planners and advisors as to what's going on in the market today and what opportunities exist. So first, let me introduce my colleague Neil DeGray. Neil and I have been working together for over 10 years now. We were together at Campbell Valuation Partners, a firm that had been around for quite some time, similar to Hull&Hull. So Neil and I have worked together on some very large estate planning matters. We have do work for both the CRA and for taxpayers, both sides of the fence. So we do have credibility with the CRA, and like I said, we work on both sides of the fence. So Neil's been doing valuation work for I think about 12 years now, and we've worked together for a long time. Hull&Hull is, let me introduce the firm. It probably goes without, doesn't probably need an introduction because it has been an established firm in the Greater Toronto area for some time, I think dating back to 1957. They have an excellent reputation for estate planning, estate and trust litigation, and planning. Ian and I have worked together on several files. And they're just an excellent firm. Jordan joins us today as well, and Jordan is a certified specialist in estates and trust law and an adjunct professor at the Osgood Law School. He is also an excellent lawyer and is going to bring a lot of value to this presentation. So with that, I'll just bring you through our agenda. We're going to try to keep this right on the hour. So I've introduced the presenters. We're going to talk about some of the unique aspects of COVID and what impact COVID-19 and the current downturn has had on valuation methodologies, and just give you some insight into what we as valuators sort of focus on, especially in these trying times. As you can imagine, in this type of a market, there's more volatility, which brings a degree of uncertainty and a heightened degree of awareness when we're doing these valuations as to what really is going on with a subject company and how the current state of affairs is affecting our opinions. We'll get into some of Duff and Phelps's guidance on cost of capital and how that's impacting valuations. And then Ian and Jordan will get into the mechanics of estate freezes and thaws and the benefits of using estate freezes as a planning tool, some practical considerations, and some war stories as to freezes that have gone wrong, which emphasizes the need to have a strong legal team when you do implement and execute these reorganizations. And we'll lastly review some relevant case law. Let me first just explain who Duff and Phelps is. Duff and Phelps, has not been in Canada since 1957, but it, as Hull&Hull has, but it has entered the Canadian valuation corporate finance world by acquiring two of the preeminent firms in Canada and merging them. So 3 years ago, they acquired my firm, Campbell Valuation Partners. 6 years before that, or 5 years before that, they acquired another firm called Counsel & Partners, and the two of us basically are now merged as a fairly large valuation firm in Canada. Globally, we now have access to resources around the world. We performed over 19,000 engagements last year. And we do deal with a lot of the larger companies as well as smaller ones, though. But it really, like, from going from a boutique firm to a global firm, it's really nice to have access to some of the industry specializations globally, and the geographic reach has really helped us in our local practice in Toronto. We have over 2,000 professionals in the Americas. We have over 1,100 professionals in Europe and the Middle East. And we're also very large in the Asia Pacific region. So we do have global reach. You can see the countries that we're involved in. I don't need to elaborate on that anymore. One of the key things that I've noticed in valuation work over the years is it's become more sophisticated. When we have big data, has really given us access to more and more information. When I was doing valuation work 20 years ago, the information that we literally had a library full of years and years and years of Globe and Mails and different papers, and we would scour those for public market information. Now we have data from all different aspects. There's capital IQ databases and so forth. And what this has really done is really heightened the need for industry expertise. And the access to a global network of people that have expertise in various industry sectors has been a critical thing for us, and a welcome asset when giving these opinions. And often what Neil and I do, we stand up in court, and what Ian and Jordan do is, they do have to go to court, and the credibility that this industry expertise provides us is essential and highly valuable to the opinions that we give. So you can see that we do operate, across all industry sectors, and this just adds to our credibility. In Toronto, the Toronto office, I believe, is the largest single office of business valuators in Canada. We're headquartered in Toronto, but we do work across the country. And our engagements we do provide a broad range of services. So we do valuation work, which is what we're talking about today, for estate, tax, and tax litigation as well. When push comes to shove, sometimes matters do get litigated when CRA decides to take a situation to task. We do economic loss and damage analysis, fairness opinions, shareholder oppression cases, and so on. So basically anything to do with an independent valuation, or if you're selling a company or you have a client or a client is looking to buy a company, we have a corporate finance capability as well. So we do a broad range of services in the Toronto office. But today we are focusing on, the estate freeze type valuations, so the estate planning valuations. So what I'd like to do is I'm going to start by just introducing sort of a high-level overview of what we're seeing in our practice about COVID-19. So we did and just to back up, just like in 2008 during the financial crisis, the first 3 weeks after the market crashed big time, the phone did start to ring, and we did have, it was a lot of tax planners, accountants, lawyers, and clients of the like calling to say, well, we did a freeze 2 years ago or something, and is it worth looking into? What's your gut telling you about the valuation impact of this COVID? Is there something that we can go forward with to maybe do a refreeze and take advantage of this? And the first call, which I'll talk to you a bit about in a few slides later, was from a fitness company, and my immediate reaction was, well, I haven't done any research, but you're sitting there, your clients can't go to the gym because you're not allowed to open the doors, so your revenue stream's gone. But not only that, but your clients are sitting at home trying to look for alternative workout platforms like Peloton, and YouTube has all kinds of workouts and so forth. So my gut was, there's probably a good opportunity here to do a refreeze, and sure enough, the data supports that. So to quote my teenage daughters, I what's the T? That's for those of you that are more my age, that means what's going on today. But I am educated by, I spent a lot more time with them over the last three months, as most people have, as we work at home. So what's the T? So, one of the key valuation methodologies that I've always adopted is a discounted cash flow methodology, which depends on a forecast cash flow and a discounting the present value of those cash flows. There's greater emphasis on the discounted cash flow during an economic downturn in situations where the future is less certain than otherwise might be the case. And Neil will highlight sort of the details of that in a second. The other going concern methodology that is often employed, and I'd say probably more commonly employed in normal times, is a capitalized cash flow methodology. And the reason for that, well, first let me explain what that is. That really, the capitalized cash flow methodology looks at company at a static point in time at the valuation date and relies on historic and maybe some near-term budgeted results for a company, and says relies on an estimation of what range of cash flows that company can generate on a go-forward basis with a relative degree of certainty. So it doesn't rely on a forecast. It relies on an estimate of a range of cash flows. And that really is not well designed in a situation where the valuation date is right in the middle of a period where cash flows are volatile, or there's a near-term expectation of either a dip in cash flows or an uptick in cash flows. And during COVID-19, not everybody is suffering. Some of my clients, our clients, are actually benefiting. So it's not just a dip to look forward to in the near term, but it's also, for those companies that are excelling, how long are they going to benefit from the current situation? So the DCF methodology is better served to account for that, and the capitalized cash flow is less so. We'll talk about cost of the other thing that's going on. Cost of capital inputs are in a state of flux. One of the nice things about Duff and Phelps is we do have this globally recognized publication called Duff and Phelps' Guide to Cost of Capital. So we'll talk about some of the guidance, but there has been a general uptick in the general equity risk premium. Industry risk premiums, which are a little bit more specific on a case-by-case basis, are in flux and require some special analysis that's a little unique to the times. I would say there's also a greater emphasis needed on a market approach, given that the market is an empirical measure of what's going on generally in the economy. Although the public company comparables are available, but the one weakness at this point in the market approach is that transactions have become fairly sparse. And then we'll talk about a technique that we've been employing in our valuations, and that is, there's a very, I think, essential analysis that needs to be done, and that is a benchmarking analysis where we look at, a pre-COVID-19 baseline valuation, and then look to the market to say, well, to what degree is this sector trending up or down from that point in time, from that baseline. So with that, I'll pass it over to Neil DeGray to just get into some more specifics about valuation methodologies in the context of COVID.
Perfect. Thanks, Chris. I think as Chris mentioned, the key takeaway from our analysis is that the discounted cash flow approach to valuation has really been the key in times like COVID, where the near term is sort of uncertain and it's difficult to have a stable, steady state business, which is required for a capitalized cash flow type of analysis. So as Chris mentioned, a discounted cash flow is really projecting out your cash flows for a business and what it's going to look like over the next 3, 5, 10 years. And really, if you think about the industry that we're in and the state of the economy, consider something like a restaurant business, it's very important to have a forecast and put a lot of effort into a forecast when doing evaluation in these times because of the uncertainty and the volatility in the performance of the business. So for a restaurant, for example, there might be a period of shutdown followed by a period of slowly the business building up to its historical customer base if it gets there. So really that is why a discounted cash flow and using a forecast is important in times such as the times we're experiencing right now. A capitalized cash flow, which is usually based on historical earnings and is appropriate for a mature, stable business. Not very many businesses at this time are sort of in that mature, stable state where you can use last year's income, for example, and say that that's going to be consistent with what we would expect over the future. Because of the uncertainty, it's very difficult to rely on last year's income as a projection for this year and next year. In certain businesses, case specific such as real estate, an adjusted net book value, which is where you look at the balance sheet or the financial position of the business and you adjust each of the assets and liabilities of that business to market value, is relevant for certain specific businesses like an investment holding company or a real estate company, where you would be valuing the real estate as a separate asset and essentially adjusting that real estate on the books to a market value based on a current appraisal. The other important thing to look at is the importance of looking at the market approach. As Chris mentioned, seeing how the market has responded to COVID is very important in terms of assessing value of any subject company and really understanding how the industry has been impacted by COVID-related measures. So understanding how the market is priced in risk, be it for any industry, is important to the valuation. So we would really look at, from a market perspective, how public market companies are trading on the stock exchanges. Are they trading up? Are they trading down? What kind of multiples are they trading at? And that is important in establishing value in these times because the market is a great indicator of how people are perceiving the risk of a certain industry. The second market approach is really looking at transactions. So if there's any transaction activity, that transaction activity can be an indicator of value. For example, car dealers are always trading at 3 times EBITDA or 3 times cash flow, 3 times income. You can use that as an indicator for what your subject business might be trading at or might be valued at. And in these times, precedent transactions are important, but it's also difficult because there has been a slowdown in general market activity. And historical transactions may not be indicative of what the market looks like today. So relying on a transaction and an implied value from late in 2019 may not be a relevant consideration today when the market is completely different and the prospects are different for those businesses. So though important to consider contemporaneous transactions, the volume and the number of transactions just isn't at the same level as it historically has been given the unprecedented measures. And finally, sort of the last thing you'd want to look at from a liquidation approach is really establishing whether this business is a going concern or not. And if it's not, in cases where a business might be wound up, considering the value of how to value a business that is sort of in the wind down mode. And just to show high level how the public market has behaved for certain industries, as can be expected, the internet and catalog retail business has really benefited from COVID-related measures, given people's propensity to now spend online instead of going to retail outlets. Software and related industries have also done well. Well, on the flip side, we have industries like energy and oil and gas and the airline industry, which have been very adversely affected by COVID-related measures. I'll pass it over to Chris again to have some benchmarking.
Yeah, so one of the, normally we're provided with a valuation date for whatever the situation is, and, we peg our valuation at that point in time. And, we would look to, once we do our cash flow analysis and assess cost of capital and develop our valuation from those primary techniques, we would then go to the public market and test those with, as Neil said, public company comparables and precedent transactions and so forth. Well, like Neil said, I totally agree that, some of the precedent transactions and market precedent transactions from, the last 3 years may and likely are not relevant during this unusual time. So one of the techniques we're employing is, we do our cash flow analysis based on the outlooks and so forth that are applicable and relevant at this in COVID time, and then we want to test that. So precedent transactions are a little bit light at this point, so that's it hasn't, in our experience right now with our caseload, has not been a very helpful tool. And public markets, have its own limitations as well. We look at public companies, and it is a different, more liquid market than private companies. But we can glean a test by saying, if we kind do a baseline pre-COVID valuation where we look back and we say, okay, if COVID wasn't around, how much would this company be worth? And we look at today's measure during COVID, let's say there's a 20% implied decline in value, we can look to the public companies and say, okay, from point A pre-COVID to point B during COVID, the valuation date, how has their peers performed? And, that gives us a sense that, if we're wildly off, maybe we need to revisit our valuation inputs. If we're kind of directionally in line, that is support and corroborates our analysis. And, some questions have come up where people have challenged that concept and said, well, this is just an unusual blip in time. Everybody expects values to turn around. So how can you say that company is worth less because their public market peers are down? And, my answer to that is the public markets are an opportunity, like there's an opportunistic investment there. So when you're valuing a private company, you can't ignore the public markets because an investor in a private company has the alternative to go and invest in that public market. So that is going to be a factor that affects value at a point in time. So I do think it's I wouldn't be using that type of benchmarking as a primary approach, but I do think it is a strong test or litmus test of the valuation, the cash flow based valuation techniques. A couple of examples, that are recent case studies that we've looked at. Neil and I are working on a fitness club, and those the public companies are directly comparable, not only in terms of the nature of the business, but also the size of the business we're looking at. And they are down significantly during COVID, which is not a surprise. Another example of a case that we were working on is it's a group of several holding companies, each of which have very minority interest positions in a multitude of private equity and real estate funds. So each specific investment, and I think there's probably like 35 of them, has a unique subset of investments that required us to do a lot of analysis on the correct peer group. So, for example, one was an outdoors type store where you can buy fishing equipment and outdoor type stand up paddle boards and that sort of stuff. And it was interesting. We looked into the peer group, and those were all down except for one, which is just kind of an interesting side note. The one that actually was performing well was a U.S. chain that specialized. They're way more heavily weighted in firearms and ammunition, and sort of tells you a little bit about our American counterparts in that they when this kind of uncertainty happened, like a lot of their population went out to gear up with some firearms. So we did remove that one from the sample, but it was kind of an interesting statistic. So anyway, the long and short, I think we've driven the point home that this benchmarking is unique to this COVID period of time, and we certainly are employing it in our evaluations. So as a transition over to Ian and Jordan, I just wanted to kind of give you a little bit of stats on why now is a good time to consider a freeze or a refreeze from a valuation perspective. And obviously, one of the things that is warrants that is necessary to justify the effort to go into a freeze or a refreeze during this time is an expectation that the shares that you're going to freeze are going to rise in value over the new shares that you issue during a freeze are going to rise in value, and that there is going to be a benefit passed on to the next generation that receives those growth shares. So I just thought I'd give some stats on past crashes and how long the recoveries have been. And you'll see that like the 1987 crash, the dot-com crash, and the 2008 financial crisis, the recovery periods in those were 2 to 7 years, but they did happen. And the most recent one, the 2008 crash, to get to its pre-crash level of the market took about five years. Now the 1929 crash was unique for a bunch of reasons, but it did take a long time. But I think the markets have built-in mechanisms now to, the governments are a little bit more aware of how to deal with these. So, there is good news that statistically, we are in a blip of a downturn. So I just thought that was an interesting thing to kind of give some comfort to people that are thinking of going forward with this type of strategy. So with that, I think it's a good time to maybe pass it on to, lastly, just very, very quickly, guide to cost of capital. I forgot to talk about this. So, there's two things in evaluation: the forecast cash flows, and we talked about how we take into account the near-term dips. But Neil, maybe you just want to talk a little bit about the impact on cost of capital from the COVID times. Maybe just walk us through this.
For sure. Yeah. So the screen sort of shows a standard buildup of how we would build up a cost of capital for a company. And really the key when we're looking at COVID is the equity risk premium, or the premium that's placed in the general market for an investment in equities, has increased or for the impact of higher risk in the market. So the guidance is that has increased from 5% to 6%. So that would have a general increase in risk, which would be a decrease in value impact. In terms of other variables that we consider, we really need to consider the industry in which the company operates and how that industry has responded, and whether the industry is higher risk or a lower risk industry in response to COVID, and also just the company specifically and its direct impact, and whether there's a need to assess a higher risk premium for that specific company given its profile.
Right. And then just, just very quickly, I don't want to get too technical in this presentation, and anyone can feel free to call me after if they want to get into the details, but there are real two components that are generally affected by this, the normalized risk-free rate, and, we have a whole think tank in Duff and Phelps that sits and does nothing but this type of empirical analysis. But the normalized risk-free rate really hasn't changed, and really it's just the guidance that we're given is still, in times like this where the spot risk-free rate is unusually low, the guidance is that we do our valuations on a long-term outlook, which we call the normalized risk-free rate, and it's still, we're saying 3%. Now it does fluctuate, there is a range, it's not an exact science, but you'll see the long-term real rate is between 0 and 2%. Long-term inflation outlook is between 1.5% to 2.5%, say, and when you put that all together, it's calling for a long-term outlook normalized risk-free rate of 3%. In the essence of time, I won't go through each of these. However, these are all of the factors that are considered when we get into the equity risk premium. And, we look at, for example, the markets, the U.S. equity markets are down drastically. That does have an upward effect on the equity risk premium and so forth. Each of these variables, it's highly technical, are considered when Duff and Phelps gives their public guidance to the world. And just a history, lastly, so you can take this away and look at it. This is a summary of the history of our guidance on risk-free rates and equity risk premiums. And you'll see that the equity risk premium had generally been declining. It fluctuates a little bit. However, recently we're back up during COVID times. We're back up to a 6% equity risk premium guidance, which is at the high end of the historic range. So with that, I will pass it on to our counterparts at Hull&Hull. Thank you for listening to that part. And Ian or Jordan, I'm not sure who's taking it away, but the floor is yours.
Well, thanks so much to both of you. That's really helpful. I've got lots of questions that come out of that and interesting analysis that we're going to have to consider. I think what we want to cover in our time, Jordy and I want to cover in our time, is just to talk a little bit about mechanics and the estate freeze as a tool. COVID brought a lot of surprises to everyone. Certainly, I can say from a litigation practice, which is my personal focus, and Jordy is on the solicitor side in the area of estates and trusts, the litigation came to a dead stop, which was interesting. And the solicitor's work, in probably, and Jordy can speak to it more directly, but went through the roof in some respects, and is still continuing to be. I remember talking to a very senior estate lawyer in Toronto about a week into COVID, and he'd got 5 calls in one day about an estate freeze. So if you're Amazon, you're looking to freeze for some reasons, and if you're a restaurant owner, you're looking to freeze for other reasons. So I guess really and this is very simplified here, but we want to look at is, the structure itself. We're going to create the frozen corporation. We're going to pass on the frozen shares to the creator, so to speak, and that'll be a fixed value shares, and they're typically in preference stature. And then the common shares are the growth shares, and here this illustration just shows it to a family trust, but it can be outright to the adult children. And that matters a little bit in the back end in terms of problems that can arise, but this is just a helpful sort of tool, because really an estate freeze, as the corporation's grown over time and becomes more profitable, the freezor retains the fixed value preference shares. and they're voting shares typically, and of course they're transferring of the common shares to the children directly or indirectly through the trust. So the reorg of the corporation allows the future growth of a company to benefit the freeze beneficiaries while minimizing the taxes triggered by the death of the freezer. So that's the kind of classic estate freeze, and one that, as I say, if you're Amazon maybe, or your holdco owns just Amazon shares, maybe that's something you'd be considering as the value went up. But there's also the possibility of a refreeze, where you consider where there's been a decline in the value of the corporate shares, which has of course been seen with greater frequency now. The value of the gross shares may fall below that of the pref shares retained by the freezor during the initial freeze. So it may be appropriate to actually repeat the estate freeze process now, and to consider whether to convert the pref voting shares that are held by the freezor, or the common shares held by the freeze beneficiaries, into a new fixed value pref share arrangement. So this alters the existing estate freeze rather than sort of reversing it, and that's an option as well. And mechanically, there's of course the options of estate thaw and an estate melt. And an estate thaw is really that, you know, all or a greater portion of the future growth that has been reacquired by the freezor through either, you know, retaining return of the gross shares through from the freezee beneficiaries, the conversion of those freezor shares into common shares, or through sometimes a discretionary family trust allows for it. But the value of the freeze beneficiaries' common shares may also be frozen as part of the process. So it's like doing it during the original freeze. So the thaw itself is an opportunity, depending where you are in the marketplace right now. An estate melt is another way, really, for the freezor to access the appreciation and the growth, in this case where someone is booming in COVID. It can be achieved a number of ways. For example, you can just simply do a salary increase, or bonuses, or management fees and share redemptions, or the combination of those things. So those kinds of tools are the classic arrangements for which you would see mechanically happening with an estate freeze. What I want to spend a few minutes on is the importance of what does it mean once we create these structures, because this is the tension that I always feel between the accounting community and the valuation community and lawyers, is the fact that the tax drives this estate planning tool, but like anything that estate planning tools they bring with it consequences, and those consequences are that you are passing control onto someone else. And often, and I can tell you over 30 years of doing this, almost 80% of the time, when I'm sitting across the table from a client and I say, well, you actually don't control the corporation. You have all the votes, but the growth shares you've given to your kids long ago, and they're starting to flex muscle that they actually have. And the way they flex muscle is using the statutory provisions of the Business Corporations Act, both in Ontario and the Canada Business Corporations Act, depending on the corporation. I mean, these are kinds of things that, you know, the common shareholders could ask for under these acts for audited financial statements, providing shareholder, you know, insisting on shareholder meetings to be held, and in closely held family corporations. Those are two big nuts. Again, I'm sure all of us see this, is that, you know, and often some of these corporate steps are not as closely followed when you've got a family-held corporation, and the governance of a family-held corporation can be looser on a day-to-day basis. Well, all you need to do is hire counsel to start to flex the muscle as the gross shareholders to create real problems for the preference shareholder and voting. Although the preference shareholder, the parent typically, or the original founder of the company, has the power to carry the votes. The remedies available are significant under the Business Corporations Act. And that's really where I think the discussion needs to be had. The tax balanced against what am I actually giving up? And further, one step further, if your spouses are involved, what kind of independent legal advice are you giving to your spouse at the time that you enter into a freeze? And those are the two sort of cornerstone discussions that I want to always go through with the client before we enjoy the tax benefits that are going to come out of the estate freeze itself. So Jordy, can I just ask you a couple things now? In terms of planning considerations, the family dynamics drive so much of estate planning generally. What kind of family dynamics do you often see where you've got where the estate freeze has been thrown out as an option, and what are some of your considerations in that regard?
Right. So thanks, Ian. It's a pleasure to be here. I mean, just to put this in perspective, the great thing about a will is you can change it every day if you want. The problem with any kind of estate freeze or other kinds of planning is it's much less flexible. And so we really, before we go down that road, very important to canvass a lot more detail in some ways, because we're not going to have the flexibility to say, well, circumstances have changed now, let's change our will. In these kinds of situations, once you've done it, subject to some very expensive unwinding, you're stuck with it. And so the planning, the looking at the family and getting those details, so important. And not just, who's there, because but the relationships among the kids, spouses of children, for example, possibilities of disability. We don't know what the future is going to hold for anyone. And when you do these kinds of freezes, exploring in detail the dynamics, because all of a sudden you're taking an asset that, for example, the mother owned and had complete control, and now shifting some of those rights over to children. Maybe those kids don't get along as well as mom might wish or think. And so those dynamics, if you're putting them all together, these kids together, that may be, a disaster. And it's not easily unwound, unlike a will. And so I think that those kinds of diving down into the dynamics, the relationships among these kids, so crucial.
So Jordy, both, well, not you, I won't speak for you because you can do it, but I went to law school because I can't do math, and lots of people on this phone call, on this webinar are experts at math, including the Duff and Phelps team. So I'm trying to avoid the math, but I do know that it's important to get a handle on the nature and extent of the assets, and those tend to be glossed over in the estate planning process sometimes, and you miss opportunities where, having not canvassed it properly, you might get into a situation where you've seen some good red flags that the estate freeze opportunities there, and you've not sought out further advice on it. What's your view on the gathering of the assets and the tax-driven part of it? Yeah.
Well, obviously the assets, because estate freezes are such a driving force in an estate freeze. I mean, obviously the details about those assets are crucial, and valuations important, but also predicting the future, right? I mean, if we've all seen, I think, situations where clients do estate freezes, and in fact, and today might be that kind of time, the values don't go up. And so all of that work was, in a sense, for naught. There's that issue, but there's the other component. So there's the assets that you're going to freeze, but then there's the other issues of assets that the client has outside of those freeze assets, because those are the assets that are going to help make sure that mom, for example, has enough money to live on. Not only the free shares, the current value of the company, but really diving down into, are there enough assets out there to satisfy all of the needs of mom? Ian, you know this, and you've seen this, where, parents do these freezes. Sometimes it's peer pressure. It's like a shiny new toy. Oh, you don't have an estate freeze. You haven't done a discretionary trust. So they end up, somebody talks them into it in a sense because it looks good. And then they turn around, they get sick, and they require 24-hour care and whatever else. And all of a sudden, they run out of money. And they have to go back to their kids and say, I need some more money, please. And so that's, it's impossible to predict the future, but knowing what other assets are out there, it's really, I think, really crucial. So it's not just the freeze assets, but all of the assets that you need to canvass with the client.
That's so true. And all right, so look, I just want to make sure that we cover off a little bit of the last part of this before we need to leave some time for questions. And I just to give an overview is what's the dark world look like if we get into a contentious situation? So we've created the freeze. The founder of the company, she's got these pref shares. There's $10 million in pref shares. It's a fixed value. Things are going fine. There's no reason to change the freeze at this point. We're in an industry that's surviving, but not moving too much volatility in the COVID environment. What kind of legal concerns can arise? And I'll just give an overview. So the common shareholders, the growth shareholders, and then in most illustrations, it's the kids, can turn around, and as I've already indicated, there are specific statutory rules that will allow common shareholders to flex the muscle. But the ultimate flex, in some respects, is where the common share, where the kids say, look, dad's running the company, or mom's running the company badly. We're the growth shares. We want to impose what is called an oppression remedy. And I want to go to the court and say, did dad or mom act in an oppressive or unfairly prejudicial manner towards us, the common shareholders, in a manner that unfairly disregards our interests? And that's the test. And if that's the test, and take a minute, I'll talk about what the test is, then what are the remedies? And these are where, unfortunately, families can come into disrepair, so to speak, and chaos can set in. It's Section 248 of the Business Corporations Act that sets out that a complainant, and that can be the common shareholders, can come to the court, and the court has to make this determination of oppressive or unfairly prejudicial. And what does that mean? Well, the Supreme Court of Canada has said whether there's been a breach of the reasonable expectations of the common shareholders. If the breach of the reasonable expectations of the common shareholders is established, then one goes on to consider whether or not the oppression or was it oppression? Was it so far up the scale that it was oppression? Was it unfair prejudice or unfair disregard? And they'll look at behavior such as the general commercial practice. Well, the general commercial practice in COVID may be a very different world now than it was then, and an oppression remedy brought in the context of COVID is almost certainly going to be a unique beast. Nature of the corporation, looking at the relationship between the parties, all of these things are what the court's going to consider. And I just want to highlight, which is probably the most telling part of the whole analysis of the case law in this area, and that is that if the relationship of the trust and confidence between the parties has broken down and the continuation of the business between them as equal partners is no longer possible, judicial intervention can be imposed, and a wind-up order or the like can be made by the court. And the unique part about state freezes is where the courts keep looking at when these get into contentious matters is that the courts say this: the fact is, if the business is a family business, you cannot ignore the provisions of Section 248. But the court goes on to say they're convinced that the fact is that the members, that because of the family business, it must be kept very much in mind in fashioning the remedy. So if you're in an oppression remedy over Bell Canada, or a publicly traded company with widely held shares, that's a very different beast than if you're going to get into a family, an oppression remedy with a family company, because they are different. Family companies are different from non-family companies. The Supreme Court of Canada has said it repeatedly in a variety of cases. And they're going to take a more liberal approach to the words just and inequitable. And I think that's really important because just to finish off the thought, really from my perspective, if we're going to get into a state freeze, if we're going to get rid of the control, what does the back end look like? What does a contentious scenario look like? And as Jordy, you pointed out so well, we don't know how children are going to behave. We don't know how children's spouses are going to behave. We don't know what the pillow talk is going to be to within the children's relationships and the pressure that may be brought by in-laws. And so while there is a tremendous value to considering the estate freeze process, I think properly guiding people through what it could look like is just as important as it is to jumping into the estate freeze itself. So Jordy, do you have any other comments? Because we want to leave time for questions.
Yeah, I think the only other comments I just wanted to make is it goes into this, it tries to solve the problems that you've raised, is to build as much flexibility as you can into the structure of the estate freeze. So, for example, separating out classes of shares for the votes versus the equity, both the growth and the equity of the founder's equity, separating those so those can be dealt with on death differently, depending on who should be in charge of those votes. That's something. Sometimes we see that the voting stuck and tied to the equity, which ties the hands of the founder or the freezor, as it were, in that they have to go together. And so I think that some of these arguments about disputes and things like that can be avoided if we use a little more flexibility when we're setting up the estate freeze. So separating voting from equity is one. The other is the idea that when you're using a trust, an inter vivos trust, that rather than fixing the distribution, so it says, when the trust is wound up, it's for example, it's discretionary to the trustee to divvy things up. Well, often clients are so shocked when that happens because they may not be the trustee or have control over that after their death. And so the idea that they perhaps can appoint the beneficiaries of the trust to be able to keep that, have that stick, in other words. If you give up too much control, you lose the stick. And if you can keep the stick, then that sometimes keeps the other beneficiaries in line. That power of appointment, that ability to divide up who's going to end up getting the fruits of the labor, as it were, so important to maintain that flexibility. And so I think that's another way to sort of discourage fighting, is if you can make sure that the founder does keep control and use every tool that's available to do that.
Well, that's great. Well, thanks so much. We're done at our end, and we're happy to pass it back over to you, Chris.
Yeah, no, thanks, Atin and Jordan. That was very informative, and there's certainly a lot of aspects that go into these. And as the valuation opinion givers, we've worked at the front end on these when the freeze is being implemented, and sort of say, unfortunately, also when it does the proverbial, hits the fan later on. Sometimes when these challenges and the muscle flexing happens with the freezees and the freezor. So lots to think about. I think we'll open up the floor now for the last few minutes here for questions, if there are any.
So panelists, there are no questions that have come in at this time. Just as a reminder to the audience, you can submit questions through your Q&A console widget on your console to ask any of our speakers today any questions that you may have.
Chris, could I ask you a question? And one thing, there's two areas that I sort of see some real and knowing who's on this webinar that may be in their mind as well. First of all, this analysis that the guys in the back room with the sharp pencils have done in terms of what the numbers are. We heard yesterday or the day before from the Minister of Finance, we're starting to hear the numbers on the government debt. They've been careful about telling us real numbers until recently, and much to my personal frustration. But we now are hearing these numbers, and worldwide will be even more dramatic. What is that going to do from your valuation standpoint, or are you going to sit back and sort of let the sort of the variables kick in and see where it goes? Because it just seems to me that's the staggering thing that we all of these crises have seen. And your chart with your history chart was so good. I just don't know that we've seen these kind of debt numbers worldwide and government levels.
Yeah, no, it is staggering, and I have the same questions as to what those debt levels are going to mean by way of taxation, by way of, how's it going to affect the economy and employment and so forth. And I think the best we can go on right now is, the wizards that do analyze these economic statistics and so forth. We're going to have to see how this all unfolds. But my own personal gut feeling is that this is going to be, I do believe in the long-term economy and the recovery, but I do think it's going to have an impact. And when people talked about a V-shaped recovery and so forth, I think it's becoming more evident. And as we see more statistics, my personal expectation is it's going to not support the V-shaped recovery. It's going to support a more smooth, longer-term recovery. But I could see, more guidance coming out on the equity risk premium, and if that's all true, you could see, an uptick in that, in the near to midterm, and that will have an impact on value. But it's a very good question, and that just goes to show you that there is an added element of risk in the marketplace today that didn't exist before all this happened.
Yeah, it's going to be amazing. I mean, the unbelievable thing about COVID, of course, is, and especially using your history chart, is that those all show that where they got out of it, and we're not even sure when we're going to get out and what kind of timing. So it's going to be interesting to see how the government debt affects everything, but it affects how you're going to make those analyses. The second question I just had was this. Lots of us, I'm 57, so I got to keep going, but lots of us have looked very seriously, and the professionals, now that's just the accounting profession and the legal profession for sure that I've anecdotally heard from through COVID. Lots of people are looking at retirement in a very different way now. They've been through what is a massive upheaval in many respects with their practices, and especially smaller solo firms and small firms. And they're looking at selling their practices from a different perspective. Are you seeing any uptick on professionals looking to you guys for help on the selling of the practice? And B, are there things that professionals who are looking at trying to sell now, and they've really been rattled by COVID over the next couple of years, are there things that they should be doing that they might want to consider? Because you guys have to value these at some point maybe, and are there some tips that we could all sort of make note of and start putting onto our to-do list to maybe enhance our values as we come forward to selling our practices? And you've been through one, having bought through Ian Campbell Valuation. So I was curious what your thoughts were on that, Chris.
Yeah, it's a good question, and we haven't seen any professional services firms come into our practice during COVID. However, both Neil and I have worked on professional service firms valuations, in recent times. We've done some personal liability practices, general practices, corporate, commercial litigation, and so forth. And the real key in adding value or enhancing value or preserving value in these practices, really taking a look at, the concept of personal goodwill versus commercial goodwill. I've been in the professional services, game for a long time, and we all know that there is a degree of relationship and personal goodwill with the key people in each of those firms. And I think that the more you can establish a brand name and also an infrastructure of strong, younger, keep the machine churning with younger people coming up in what I refer to as the farm team. rising them in the ranks and really having that infrastructure so that when you sell the firm, and look, your firm has your name in it, which, you know, somebody might say, well, that just indicates it's all Ian, but you've been around for a long time, and I know that's not the case. You have an infrastructure there, but the more you can build up that infrastructure, say, look, I'm going to merge with, you know, firm A, B, or C, or sell, or however you structure it. You're not just getting, you know, me for the next 5 years as I, you know, wind off into the retirement sunset. You're getting a very strong team and a very strong brand. So I think those are the things that professional service firms should focus on to enhance value.
That's great.
So
Thanks so much,
panelists,
Chris.
sorry. So panelists, we have time for one more question that just came in. And again, to all the audience members, we'll if we don't answer every question, we'll be sure to follow up and get those addressed. Just a quick one that came in. Has Duff & Phelps seen deal flow begin to pick up post-COVID? Has COVID had any impact on owners' appetite to consider a transition out of their business?
I have my, I'm tuned into our corporate finance team pretty carefully. I think that deal flow has slowed. I mean, it's a short period of time. Deal flow, you know, deals, you know, ebb and flow with the economy, and you know, we're still only into this thing for 3 months. I'd say new deals have slowed down, and some of the ones that our corporate finance team has worked on have been put on hold. That said, I have been passing along to all my LinkedIn feeds, you know, the successes that Duff & Phelps has had recently, and there have been some fairly significant ones. And sometimes these transition from an outright sale to a restructuring and so forth. So, you know, it's different type of work, and we're seeing that kind of thing picking up a little bit, you know, recapitalizations and so forth. So, and I expect that to continue, but it's a difficult time to, you know, for an owner that was planning to just do a complete sale to get out and move on into their own sort of next phase of life. Yeah, for certain businesses, it's a difficult time. There still is a lot of money looking for good deals, though. So for businesses that are benefiting from this, you know, it could be a time, you know, where you can achieve a premium. You know, for example, in the food and beverage industry, there's a lot of, you know, if you're focused in food and beverage and in retail, as opposed to food services and restaurants, you know, that industry has seen a massive bubble of demand as we've moved through this scene, and anything to do with home delivery and online shopping and all of that world, you know. There is in my feeling is there's a premium to be had there. So I think we'll see some activity pick up, but it does feel like there's been a let's sit back and pause for a second and see what this really means.
Great, thanks for that. So we're about 5 minutes over, so I believe we're out of time. I just want to say thank you to all the attendees today for attending. I hope this was insightful. Thank you to all the panelists, to Duff & Phelps, Hull&Hull. I think this was a great webcast, and stay safe and well to all the attendees.